What if I told you that the single most important financial decision you could make right now isn't about stocks, bonds, or even gold? What if the real story, the one that could determine whether your retirement survives or crumbles in the coming months, is sitting in a metal that most people completely overlook? I'm talking about silver. And I'm not talking about buying it someday. I'm talking about getting physical silver in your hand today. Not tomorrow, not next week, today. Here's what nobody's telling you. While everyone's been watching gold break records and celebrating new all-time highs, silver has been quietly setting up for something that hasn't happened in over 40 years. We're witnessing the convergence of forces that last came together in the late 70s and early 80s, right before silver went absolutely parabolic. But this time, the setup is even more extreme. The supply deficit is deeper. The industrial demand is unprecedented. And the amount of physical metal available for investment? It's vanishing at a rate that would shock you. Let me paint you a picture of what's actually happening right now in the silver market, because this is where it gets interesting. The global silver market is running a deficit that analysts are calling historic. We're not talking about a small imbalance. We're talking about a structural shortage, where industrial demand alone is consuming more silver than the world's mines can produce. Add in investment demand, jewelry fabrication, and the massive surge in solar panel manufacturing, and you've got a situation where the math simply doesn't work anymore. Think about this for a second. Every single solar panel requires silver. Every electric vehicle uses significantly more silver than a traditional car. The green energy transition that governments worldwide are pushing, it's a silver consumption machine. And here's the kicker. There's no substitute that works as well. Silver is the most conductive metal on Earth. You can't just swap it out for something cheaper when the price goes up. Industries need it. They have to have it. And they're competing with investors like you for a shrinking pool of available metal. Now, I want you to understand something critical about how silver differs from almost every other investment you might consider. When you buy stocks, you're buying a piece of paper that represents ownership in a company. When you buy bonds, you're lending money to a government or corporation. But when you buy physical silver and hold it in your hand, you own something real, something tangible, something that's been recognized as money for 5,000 years. No counterparty risk, no bankruptcy risk, no risk that some CEO makes a bad decision and your investment evaporates overnight. Before we go any further, I want to make sure you have access to something I put together specifically for people watching this video. I've created a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their hard-earned savings. It's in the description below. Grab it while you're thinking about it, because what I'm about to show you is going to make a lot more sense once you understand these foundational principles. Let's talk about what's happening with the price right now, because this is where most people get confused. Silver recently touched levels we haven't seen in decades. The metal has been climbing steadily, breaking through resistance level after resistance level. But here's what the charts aren't showing you. The physical market and the paper market are starting to diverge in a way that's absolutely unprecedented. You can look at the futures price on the COMEX and see one number. But try to actually buy significant quantities of physical silver at that price? Good luck. The premiums over spot have been exploding. Dealers are struggling to keep inventory. Mints around the world are rationing production. This tells you something crucial. The paper price, the number you see on financial websites, is increasingly disconnected from the reality of what it costs to actually acquire and hold physical metal. And that gap? It's a warning sign. It's the market screaming that something's broken in the pricing mechanism. When you can't buy the physical product at the paper price, one of two things is true. Either the paper price is too low, or the physical metal is becoming genuinely scarce. In this case, it's both. Let me take you back to a moment in history that rhymes with what we're seeing today. In 1979 and 1980, silver went from around $5 an ounce to $50 an ounce in a matter of months. People who understood what was happening made fortunes. People who waited, who thought they had more time, watched from the sidelines as the opportunity of a lifetime passed them by. What drove that move? A combination of inflation fears, currency debasement, and a supply squeeze. Sound familiar? Sound. But here's what makes today different, and potentially more explosive. Back then, silver was primarily a monetary metal and an industrial commodity. Today, it's all of that, plus a critical component in the technologies that are supposed to save the planet. The industrial demand in 1980 was a fraction of what it is now. The deficit we're running today makes that era look tame by comparison. And the amount of above-ground silver available for investment? It's been declining for years as industrial users consume more and more of the available supply. Think about the Hunt brothers for a moment. Two men, with admittedly deep pockets, were able to corner a significant portion of the silver market and drive the price to $50. They did this by taking physical delivery of futures contracts, forcing the shorts to actually produce the metal. Eventually, the exchange changed the rules to stop them, but not before silver had one of the most spectacular runs in commodity history. Now imagine what happens when it's not two billionaires trying to corner the market, but millions of individual investors around the world all trying to acquire physical silver at the same time. The exchanges can change the rules on paper trading. They can't create physical metal out of thin air. Here's something that should concern you about your retirement security. The traditional 60-40 portfolio, 60% stocks and 40% bonds, is built on assumptions that no longer hold true. It assumes that bonds provide safety and steady income. It assumes that stocks will continue their long-term upward trend. It assumes that the dollar will maintain its purchasing power. Every single one of those assumptions is being challenged right now. Bond yields have been volatile. Stock valuations are stretched by historical standards. And the dollar? Well, let's just say that when you're running trillion-dollar deficits and printing money to cover your obligations, the long-term outlook for purchasing power isn't exactly rosy. This is where silver comes in as a different kind of insurance. It's not correlated to stocks. It's not correlated to bonds. When financial markets panic, when currencies come under pressure, when inflation starts eating away at purchasing power, silver has historically performed a very specific function. It preserves wealth. It maintains purchasing power. An ounce of silver today will still be an ounce of silver 10 years from now, regardless of what happens to the dollar, the euro, or any other fiat currency. Now let's talk about the supply side of this equation, because this is where the story gets really interesting. Silver mining is not like flipping a switch. You can't just decide to produce more silver because the price is going up. It takes years to bring a new mine online. You need to find the deposit, get permits, build infrastructure, and then actually extract the ore. And here's the thing. Most silver isn't even mined as a primary product. It's a byproduct of copper, lead, and zinc mining. So even if silver prices double, you're not going to see a massive surge in new supply unless the prices of those other metals also justify increased production. The major mining companies have been telling us for years that they're struggling to replace reserves. The easy deposits have been found and mined. What's left is deeper, lower grade, and more expensive to extract. Meanwhile, demand keeps climbing. Solar panel installations are breaking records. Electric vehicle production is ramping up. The electronics industry needs more silver every year. And now you've got investors waking up to the fact that maybe, just maybe, they should own some physical precious metals as a hedge against all the insanity in the financial system. Let me tell you about something that happened recently that should make your ears perk up. Several major banks and financial institutions have been quietly accumulating silver. Not paper silver, physical silver. They're taking delivery. They're building stockpiles. Why would they do that if silver was just another commodity? Why would sophisticated financial institutions with access to every investment vehicle imaginable choose to tie up capital in physical metal that doesn't pay interest or dividends? Because they understand something that most retail investors don't. They understand that in a world where trust in financial institutions is eroding, where currency debasement is accelerating, where geopolitical tensions are rising, physical precious metals are the ultimate form of financial insurance. Think about what's happening with central banks and gold. They've been buying gold at a record pace. Why? Because they're diversifying away from dollar-denominated assets. They're preparing for a world where the dollar isn't the undisputed global reserve currency. And while gold gets all the headlines, silver is gold's little brother that's been overlooked and undervalued for decades. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio was somewhere between 15-1 and 20-1. Recently, it's been much higher. That tells you that silver is cheap relative to gold. And when that ratio starts to compress, as it inevitably does, silver tends to outperform gold by a significant margin. Here's a question I want you to consider. If you had to flee your country tomorrow, if you had to leave everything behind and start over somewhere else, what would you take with you? You can't take your house. You can't take your stock certificates. You can't even necessarily take your bank account if the government decides to freeze assets or impose capital controls. But you can take physical precious metals. They're portable. They're universally recognized. They're liquid. You can sell them anywhere in the world. This isn't some far-fetched scenario. This has happened repeatedly throughout history. People who had physical gold and silver were able to preserve their wealth and rebuild their lives. People who had everything tied up in paper assets often lost everything. Now, I know what some of you are thinking. You're thinking, but I have my retirement account. I have my 401k. I'm diversified across different mutual funds. I'm fine. And maybe you are. But let me ask you this. How much of your retirement is in assets that you actually control? How much of it could you access if the financial system seized up for a few days or weeks? How much of it is protected against the kind of inflation that we've been seeing? Because here's the uncomfortable truth. Your retirement account is a series of electronic entries in a database. It's a promise that someone will pay you in the future, and promises can be broken. Let me tell you about something that doesn't get talked about enough. The COMEX, the exchange where silver futures are traded, operates on a fractional reserve system. That means there are far more paper claims on silver than there is actual physical silver in the warehouses. It's kind of like a bank. As long as everyone doesn't try to withdraw their money at the same time, the system works fine. But what happens when a significant number of futures contract holders decide they want physical delivery? What happens when the industrial users who need silver for production start competing aggressively for available supply? The system gets stressed. And when systems get stressed, they break. We've already seen glimpses of this. There have been moments when the spread between the futures price and the physical price widened dramatically. There have been times when major dealers simply couldn't source enough product to meet demand. These are warning signs. They're telling you that the market structure is fragile, and fragile systems don't give you a lot of warning before they break completely. Here's something else to consider. The amount of silver held in exchange-traded funds has been growing, but it's still a tiny fraction of the overall investment market. If even a small percentage of the money currently sitting in stocks or bonds decided to move into physical silver, there literally isn't enough metal available to satisfy that demand at current prices. The price would have to rise, potentially dramatically, to ration the available supply. This is basic economics. When demand exceeds supply, prices go up. And in the case of silver, the supply is relatively fixed in the short term, while demand is accelerating. Let's talk about what this means for you personally. If you're approaching retirement or already retired, you've spent decades building up your nest egg. You've saved, you've invested, you've been responsible. And now you're watching inflation eat away at your purchasing power. You're watching your grocery bills climb. You're seeing your utility costs rise. You're feeling the squeeze. And you're wondering if there's anything you can do to protect what you've worked so hard to build. This is where physical silver becomes more than just an investment. It becomes a strategic allocation, a hedge, a form of insurance that you hope you never need but are grateful to have if things go sideways. Because here's the reality. We're living in unprecedented times. The amount of debt in the global financial system is staggering. The level of money printing that's occurred over the past few years is historic. The geopolitical tensions are rising. The trust in institutions is declining. These are not normal times. And normal investment strategies might not be sufficient. Now, speaking of protecting your retirement, if you're sitting on $100,000 or more in retirement accounts, I want to make sure you're aware of something. I've put together a comprehensive guide on how gold IRAs work. It's in the description below. This covers how you can get physical precious metals into your retirement account without triggering tax penalties. It explains the process, the benefits, and the potential pitfalls to avoid. If you're serious about protecting your wealth from market volatility, currency debasement, and geopolitical chaos, this is information you need to have. It's free, it's educational, and it could be one of the most important financial decisions you make. But let's get back to silver specifically, because I want to make sure you understand why 50 ounces is the number I'm talking about. 50 ounces of silver is substantial enough to make a real difference in your financial security, but it's not so much that it's out of reach for most people. At current prices, we're talking about an investment that's meaningful but manageable. And here's the key. It's physical. It's in your possession. It's not dependent on the solvency of a bank, the performance of a company, or the promises of a government. Think about what 50 ounces of silver represents. It's a tangible store of value that's been recognized for millennia. It's a hedge against currency debasement. It's a speculation on a supply-demand imbalance that's getting worse by the day. It's insurance against financial system instability. It's all of these things wrapped into one simple, elegant package. You buy it, you take possession, you store it securely, and you sleep better at night knowing that no matter what happens in the financial markets, you have something real, something valuable, something that can't be printed into existence by a central bank. Let me tell you about the psychology of owning physical precious metals, because this is something that's hard to explain until you've experienced it. There's a profound difference between seeing a number on a screen that represents your investment and actually holding a stack of silver coins or bars in your hand. When you hold physical silver, you feel the weight, you see the shine, you understand in a visceral way that this is real wealth. It's not a promise, it's not a derivative, it's not dependent on someone else's ability or willingness to pay, it's yours, completely and totally. This psychological aspect matters more than you might think. In times of crisis, when markets are crashing and people are panicking, the investors who stay calm are the ones who survive and thrive. And it's a lot easier to stay calm when you know you have a portion of your wealth in something that can't go to zero. Silver has intrinsic value. It has industrial uses. It has monetary history. It's not going to disappear overnight like a tech stock that turns out to be a fraud or a cryptocurrency that gets hacked. Now let's address something that comes up whenever we talk about precious metals. People say, but silver doesn't pay dividends. It doesn't generate income. It just sits there. And that's absolutely true. Silver doesn't pay you to hold it. But you know what else doesn't pay you? Insurance. You don't buy homeowners insurance expecting it to generate income. You buy it hoping you never need it, but knowing you'll be grateful to have it if your house burns down. Silver is financial insurance. It's protection against scenarios that you hope never materialize, but that are becoming increasingly plausible. And here's something that doesn't get mentioned enough. The opportunity cost of not owning silver might be far greater than the opportunity cost of owning it. If silver does what many analysts are predicting, if it goes on a run like it did in the late 70s, the gains could be substantial. We're not talking about modest returns. We're talking about the potential for life-changing wealth preservation and growth. Missing out on that because you were chasing an extra % or 2 of yield in a bond fund would be a tragedy. Let me paint you a scenario. Imagine it's 2 years from now. The supply deficit in silver has continued to worsen. Industrial demand has kept climbing. Investment demand has surged as more people wake up to what's happening. The price has moved significantly higher. You're watching this unfold, and you're kicking yourself because you knew about this opportunity. You watched this video. You understood the fundamentals. But you didn't act. You waited. You thought you had more time. And now the silver that you could have bought at today's prices is trading at multiples of what it was. How would that feel? Contrast that with this scenario. You take action today. You acquire 50 ounces of physical silver. You store it securely. And then you watch as the market dynamics play out exactly as predicted. The price rises. Your investment grows. But more importantly, you have peace of mind. You know that a portion of your wealth is protected. You know that you took action when it mattered. You know that you didn't let fear or procrastination rob you of an opportunity. Here's what I want you to understand about timing. Markets don't wait for you to be ready. Opportunities don't pause while you deliberate. The silver market is setting up for something significant, and the window to position yourself advantageously is not going to stay open forever. Every day that passes, more investors are figuring this out. Every day, more metal gets consumed by industrial users. Every day, the available supply for investment shrinks a little bit more. Think about the people who bought gold in the early 2000s when it was a few $100s an ounce. They were called crazy. They were told that gold was a barbarous relic with no place in a modern portfolio. And then gold went on a decade-long bull run that saw it increase by more than 6 times. The people who bought early, who understood the fundamentals, who had the courage to act when others were skeptical, they were rewarded handsomely. Silver is setting up for a similar move, but the fundamentals are even more compelling because of the industrial demand component that gold doesn't have. Let me tell you about something that keeps me up at night. It's the fragility of our just-in-time supply chains. We saw during recent global disruptions how quickly things can break down. Shelves empty, products unavailable, delivery times stretching from days to weeks to months. Now apply that thinking to the silver market. What happens when industrial users start panicking about securing supply? What happens when they start bidding aggressively for available metal? What happens when investment demand surges at the same time? You get a squeeze. You get a situation where price becomes almost irrelevant because the primary concern is just getting your hands on the physical metal. This is why I'm emphasizing physical silver in your hand today, not a promise to deliver silver in the future, not a paper claim on silver sitting in a vault somewhere, not shares in a fund that supposedly holds silver, physical metal that you possess. Because when the squeeze happens, if the squeeze happens, the difference between owning physical and owning paper could be the difference between preserving your wealth and watching it evaporate. Here's a question that should concern every retiree and near retiree. What happens to your purchasing power if inflation continues to run hot? What happens if the official inflation numbers, which are already concerning, are actually understating the real erosion of purchasing power? Because if you talk to real people about their actual expenses, the inflation they're experiencing is often much higher than what the government statistics suggest. Food costs are up dramatically. Energy costs are volatile. Healthcare costs keep climbing. And if you're on a fixed income, if you're living off your retirement savings, this is a direct assault on your standard of living. Silver, historically, has been an inflation hedge. When the purchasing power of currency declines, the price of silver in that currency tends to rise. It's not a perfect correlation, and it doesn't happen overnight. But over time, precious metals have maintained their purchasing power in a way that paper currency simply cannot. An ounce of silver today will still be an ounce of silver in 10 years. Can you say the same about the purchasing power of a dollar? Let me share something with you about the institutional players in this market. There are large entities, sovereign wealth funds, family offices, and sophisticated investors who have been quietly accumulating physical precious metals for years. They're not doing this because they're dumb or unsophisticated. They're doing it because they understand something fundamental about wealth preservation. They understand that in a world of unlimited fiat currency creation, hard assets with limited supply become increasingly valuable. They understand that diversification isn't just about owning different stocks or bonds. It's about owning different asset classes, including assets that exist outside the traditional financial system. These institutional players have access to information and analysis that most retail investors never see. They have teams of economists and strategists studying market dynamics, and they're buying physical silver. That should tell you something. When the smart money is moving in a particular direction, it's worth paying attention. Now, I want to address something that might be holding you back. Maybe you're thinking, I don't know how to buy silver. I don't know where to store it. I don't know if I'm getting a fair price. These are legitimate concerns, but they're not insurmountable obstacles. There are reputable dealers who specialize in precious metals. There are secure storage options if you don't want to keep it at home. There are resources available to help you understand pricing and premiums. The key is to educate yourself and then take action. And here's the thing about education. You're doing it right now. By watching this video, by thinking critically about your financial security, by considering alternatives to the traditional investment paradigm, you're already ahead of 90% of people. Most people never question the conventional wisdom. They never think about what happens if the system doesn't work the way it's supposed to. They never consider that maybe, just maybe, the experts don't have all the answers. Let me tell you what I think is going to happen over the next few years. I think we're going to see continued pressure on fiat currencies. I think we're going to see ongoing supply deficits in silver. I think we're going to see industrial demand continue to grow as the green energy transition accelerates. I think we're going to see more investors wake up to the opportunity in precious metals. And I think we're going to see silver prices move significantly higher. I could be wrong. Markets are unpredictable. But the fundamentals are pointing in one direction, and that direction is up.